is a bond? Have you ever heard the term bond and wondered what it means? You're in luck. Today we're unpacking the concept of bonds. Picture this, your friend Alex. He wants to open a cafe, but he needs some money. But instead of borrowing from a bank, Alex offers you and a few others an opportunity. Lend him the money and he'll not only return it after a specific amount of time, but will also pay a little extra every year as a thank you for your trust. So this thank you is called interest. And this arrangement, well, in the financial world, it's similar to how a bond works. At its core, a bond is a loan, but instead of you borrowing money from a bank, organizations like governments or companies or even banks borrow money from you, the investor. And typically bonds will have a par or face value, which is the amount which will be returned to you when the bond matures or reaches its end date. Then there's interest or coupon. The reward for lending money, issuers normally pay interest either annually or semi-annually, and this is known as a coupon rate. Then there's maturity date, which is the date by which the issuer promises to repay the par value associated with the bond. So why would you invest in bonds? Well, first, they offer steady income. They provide regular interest payments, which can be especially appealing if you're looking for a constant income stream. They offer diversification, which can balance out riskier elements in a portfolio, offering a level of safety, and capital preservation, because assuming the issuer doesn't default, you'll get back your initial investment or close to it at maturity. Bonds are generally considered a low-risk investment option due to their predictable nature. Over the long term, they tend to have lower growth than when compared to higher-risk investments, such as stocks. But remember, just because they're low risk doesn't mean they're risk-free. They have interest rate risk attached. When interest rates rise, bond prices tend to fall. They have credit risk, because there's always a risk, however small it might be with some issuers, that the company or government may not be able to pay back the principal or the interest. And then there's inflation risk. Over time, the real value of money can erode due to inflation, and if that decrease in the value of money exceeds the value of the bond's interest and par value, well, then you've lost money. So who issues these bonds? Well, governments, local authorities, and companies all issue bonds. But typically, the more likely an issuer is to pay back a loan, the lower the coupon rate will be because they're considered more predictable and less risky. As a result, governments tend to have the lowest coupon values as they're considered the most predictable to pay back their debts. Or in other words, the more risk you take on a bond, the more you'll be rewarded for such a risk. There are ratings agencies which will give credit ratings to issuers based on how likely they are to pay back their loans. For example, a junk bond is a debt which has been given a credit rating below investment grade. As a result, these junk bonds are riskier since chances are the issuer might default is higher than the average bond. And because of this higher risk, investors are compensated with higher interest rates, which is why junk bonds are also called speculative yield bonds. There are loads of different types of bonds. There's zero coupon bonds, which don't offer a coupon but are sold at a much lower price than their par value. There's convertible bonds, which may allow you to convert the bonds into shares of the issuing company. There's perpetual bonds, which have no maturity date and pay interest forever or until the issuer decides to buy back the bond. There's floating rate notes, which have variable interest rates. And in short, bonds are extremely varied, and new types are sure to be created in the future. But for now, in essence, bonds are IOUs where you lend money and earn interest. They offer steady income, diversification, capital preservation, but do come with some risks, and credit ratings track the risk of a bond not being paid back, and the higher rating that you have, or the worse rating, the higher coupon you're more likely to receive. And if you're interested in getting started with investing, why not click the link in the description? I'll organise a complimentary consultation between yourself and a Black Tower advisor going forward. Thanks for watching. I've been Luke Staden. I hope you enjoyed the video.